Welcome to this week's Market Talk. I'm Amber Lancaster, joined by Paul Mampilly and Ian Dyer. Each week, we look forward to sharing our viewpoints with you, our readers, and giving insight into what's on our radar. Today's outlook is for the week of April 15th, 2019. I'll begin by sharing with you what I'm watching, and then we'll hear from Ian and Paul. Today, I'll cover three major topics. The first will be my take on the U.S. economic data and earnings release front. The second will be my story of the week. And the third will be the latest numbers on our disruptification index. On the economic data front, this week will be a 4-day trading week in the U.S. stock market due to the Good Friday holiday on April 19th. But despite an abbreviated week, this week will be full of pertinent economic data releases. The most notable release we'll keep an eye on are retail sales on Thursday. The median forecast of economists surveyed by Bloomberg are calling for a 1% gain following a slight decline in February, which is mostly attributed to cooler weather and a downtick in building material sales. But since then, we saw a stronger than expected uptick in March vehicle sales on April 4th. This shows U.S. consumers are positive on buying large ticket items and that February's retail sales numbers decline was overstated. Take a look at this chart. According to data from Auto sales reached a seasonally adjusted annual rate of 17.5 million in March, up from 16.6 million in February. This is the highest reading in 3 months, quite a bounce higher. It's also worth noting that since its recent low in February 2009, U.S. auto sales are up 93%. So in all, consumers continue to spur growth in the U.S. economy, and we anticipate retail sales will reflect this uptick in forthcoming data releases. Now, here are the other key economic releases in this condensed week ahead. As you can see in this graphic, industrial production's month-over-month reading will be released on Tuesday, April 16th at 9:15 a.m. On Wednesday, April 17th, February's trade balance report will be released at 8:30 a.m. and wholesale inventories month-over-month reading for February will be released at 10 a.m. As previously mentioned, retail sales advanced month-over-month for March will be released on Thursday at 8:30 a.m. and also on Thursday, we'll have a March print for the leading index at 10 a.m. And rounding out this week, we have housing starts for March. They'll be released on Friday at 8:30 a.m. It's also a big week for earnings releases. Check out this list of earnings releases for this week of top U.S. securities per Bloomberg. We'll see releases from 51 companies in total just through Thursday. Those companies include Johnson & Johnson, Bank of America, United Health, IBM, and PepsiCo. My story of the week focuses on a company that's described as the leading provider of automated multiplex molecular diagnostic testing systems. The company, GenMark Diagnostics, is making news because it's on an FDA approval winning streak that's worth noting. Today, the company announced that it has received FDA 510K market clearance for its ePlex blood culture identification gram-negative panel, also known as BCID-GN. An example of this panel is seen in this image. This is the third ePlex BCID panel to receive FDA clearance during the past 4 months. Now, what makes ePlex so special? So say, for instance, you or a loved one is unfortunately rushed to the emergency room with symptoms that appear to be sepsis. Now, sepsis is a potentially life-threatening condition caused by the body's response to an infection. Now, GenMark's proprietary ePlex systems, as seen in this image, aims to help clinicians identify bacterial and fungal organisms as well as antibiotic resistant genes within approximately 1.5 hours of blood bottle positivity, allowing treatment decisions by doctors to occur days earlier than with conventional methods. Now, per the company, GenMark's ePlex is designed to optimize laboratory efficiencies and address a broad range of infectious disease testing, any needs in that arena, including respiratory, bloodstream, and gastrointestinal infections. Now, turning to our disruptification index, this chart and graphic shows it continues to do well year to date. As of Friday's April 12th close, the index is up 25% versus 13% on Dow and 16% on the S&P 500. And lastly, I want to end my part of this segment with saying happy tax day to those of us who are paying a tax bill today. I have a set of nice freebies and treats for you. Check out this screenshot from usatoday.com. They have a great article posted listing nearly 40 freebies being offered by local restaurants, stores, and travel sites for today. So you can find this list by searching Tax Day Freebies on the USA Today website. So that's it for me. Ian, what are you watching?
Thanks, Amber. So on a macro scale, I want to go over a couple things that happened last week. So on Thursday, the PPI number came out, and this measures the price of goods and services that companies are charging. So this was up 0.6% in March. And this can usually be tied to some sort of inflation forecast. However, a big part of this number comes from food and energy. And with oil up about 14% over the past month, we don't believe that this is going to have any huge impact on inflation. And overall, inflation has stayed pretty flat, around 2%, give or take 0.1 or 2% over the past couple of years. So this is a really remaining a healthy environment. And of course, low inflation means that interest rates are going to stay low, which means there's a healthy home buying market. We're still seeing big wage growth, so 3.2%, which is the highest we've seen since the '08 crash. So things are looking really good. People are making more money at a faster rate than the prices of things are going up. And we don't believe that this PPI number is going to have much of an effect on inflation at all. So with the consumer staying healthy and the home buying market, the real estate market staying healthy as well, this is turning out to be a great year so far for the economy. And then on Friday, it got even better with the jobless claims number of 196,000, which is the lowest for any week since 1969. So it's about 50 years since we've had a number that low. And of course, back then, there were a lot less people in the workforce. So that makes this even better. So the jobs market's healthy. Now the consumer remains healthy with the high wages. And the real estate market with low inflation and low rates is going to continue to be healthy as well. So for this week, in terms of disruption, I wanted to talk about the current state of robotics. And 2018 was a huge year, especially for the US, where we brought in a record 35,880 robots to kind of work in the United States. And in the meantime, unemployment fell from 4.1% to 3.7%. And we created about 2.7 million jobs in the past year. So while there's been a lot of speculation and a lot of forecasts recently about robots ruining the workforce and causing a crash in the economy, we've kind of seen the complete opposite so far. And of those 2.7 million jobs, 1.6 million were in really key industries like manufacturing, construction, education, and healthcare. These were the biggest 4 job growth industries we saw over the past year. So right now, on the flip side of that, there is a decline in the amount of retail workers. There's been about a 2-year downtrend in this, and there's a supply crunch, and these companies really can't find steady work. So this is an area where robotics can really thrive. And we've seen Walmart recently state that they're adding 4,000 robots to their stores to do just typical mundane tasks like polish the floors and scan and sort inventory. And this is a good sign because that means that people are getting a higher kind of choice in whatever they want to do. So we're not seeing jobs be filled in things like polishing floors at Walmart where people don't really want to have that job. we're seeing people get a higher pick of whatever they want to do in this economy. And so the jobs market is remaining very, very healthy. And there was actually a recent survey taken of over thousands of companies all over the world by a group called Manpower Group. And 87% of those companies said that they're looking to expand or maintain their current level of workforce because of automation. So automation is not taking jobs, it's actually increasing them, because these companies are finding ways to have their employees work alongside the robots rather than having their jobs taken. And these companies are really, really progressive. They are innovative. They're finding ways to grow despite the increase in automation. And 83% of these companies also said that they are finding ways for their internal staff. So they're taking people that already work there. They're teaching them new specialized skills that the robots can't learn, while the robots do more administrative tasks, things that take a little bit longer for people to do. So it's more efficient because they're basically computers doing humans' jobs, where the people are moving into more specialized roles that involve more critical thinking and management and things like that. So rather than being displaced, we're just finding new jobs for workers, and there's a shift rather than kind of an uprising from the robots and kind of an overthrowing of the things as how we know it. And despite all of the forecasts to say this is going to happen, we're seeing the complete opposite so far. So we see robotics and automation as actually a good thing for the jobs market, because it can clear room for higher potential jobs and more specialized skills that people can learn and do these jobs alongside the robots. So that's all I have for this week. And Paul?
Thanks, Ian. Those are all great points. And everything that you're saying, I also see in my newsfeed with respect to farming, where some of the same challenges are there, and robotics and automation is coming into farming in such a big way, because farmers just really cannot hire enough labor force to do it. So they are investing in robots in a big way. And anyone that currently wants to work in farming has to know how to work with these robots. So I'm going to start, as I usually do every week, with a kind of macro perspective and some opinions about what is going on with respect to this mix of where politics, finance, money are all mixed up together. And I was very interested by seeing this headline this morning, says that President Trump says the Dow should really be up over 5,000 to 10,000 points if it wasn't for what the Federal Reserve did last year. And that's a very interesting perspective that President Trump brings. And really, there's no way to really know this. I mean, for sure, it's now clear that the Federal Reserve was on the verge of potentially making a very large mistake, which is that they were planning to raise interest rates all the way up to potentially as high as 4% or maybe even a bit higher when there was no inflation. In other words, they'd have slowed the economy down for really no reason at all. And thankfully, they had the guts, courage to change their mind, so that's a good thing. And that plays into the second thing that's sort of milling around, which is who should sit on the board of the Federal Reserve. And there's a debate ongoing that President Trump's nominees, he's nominated a man named Stephen Moore and someone named Herman Cain, as to whether or not these people are qualified to sit on the board, or whether this should be something that is only sort of exclusive for elite economists. And given the pretty poor track record of the Federal Reserve, which is that they have largely been involved in pretty much every financial crisis, every financial accident really that's been there, largely by raising interest rates too much in the last 20, 25 years, or prior to that, raising interest rates too late to stanch off inflation, their record is fairly poor. And from my perspective, having a variety of perspectives, a businessman's perspective, like Herman Cain, I can't remember the name of the pizza company that he ran, I believe would actually help. In other words, just having a purely theoretical viewpoint constantly representing the Fed has really been pretty bad for us as a country. And also having people that represent regular people, which is that financing costs of houses, cars, these need to be taken into account versus just some theoretical models as to what is supposed to happen. So while I have really no actual strong view as to who should sit, nonetheless, it's good for us to have a debate And personally, I appreciate that this debate is going on as to what's going on. With respect to the stock market, as Amber brought up, unbelievable number of companies that are reporting. In fact, this morning, Goldman Sachs and Citibank both reported their numbers. Now, these are companies that largely we at Bull Profits are largely uninterested in. They just help make up the mood of the market. However, in terms of what actually goes on there is less of interest to us. More importantly, what I did see this morning, which was really a great sign and like lends itself to many things that we talk about here, is that there were 3 deals that came today. A company called Waste Management is buying a company called Advanced Disposable Services for $4.9 billion. And so that's a 20% pop for the company that's being acquired. A company called Catalent is buying a company called Paragon for $1.2 billion. And Electronics for Imaging is being taken over by a private equity company. And the total value of these deals is nearly $10 billion. And that tells you one thing, which is that there is confidence in this economy for people to put down big money. And one of the reasons why you're seeing at least the first 2 deals is disruption, which is that disruption does require you to invest. Robots do cost money up front. And what is happening is that companies that are either too late or don't have the resources to invest, they're choosing to merge so that they can pool their resources and make the capital investment so they can prepare themselves for what really is happening, not going to happen, happening right now. And you know, I'm interested in IPOs, and I've been saying now for some time that I believe that IPOs, I believe, are going to be a bigger and bigger deal to the market because of the fact that over the last 20 years, we've really seen the number of stocks in the US stock market essentially half. It used to be something close to 9,000 or so stocks in the market at the peak, I believe it was 2000. And today there's just a little over half than that, which means that there is a ready market, a ready audience for these IPOs. And we've seen Lyft go public. And yes, I do know that it's below its IPO price. However, that's not unusual. That's not a big deal. That's just the demand and supply dynamics of what happens with every IPO. This week, Pinterest, the social media company, is supposed to go public. Uber released its S3 filing. This is the big, huge, wad of paper that they dump at the Securities and Exchange Commission that tells you everything about the company. And it made for some pretty interesting reading. In fact, in our Friday investment discussion, Amber, Ian, and our larger team, we were talking about the kinds of numbers Uber is throwing around. They're talking about between all the businesses that they're involved in at being a $12 trillion opportunity. That's right, a $12 trillion opportunity. I have to say that in my entire time, I have never seen any IPO, not Google's IPO, not Facebook's IPO, not any IPO ever put their addressable market at $12 trillion. I mean, this in success mode, Uber could be a gigantic company. They could dominate transportation. They'd dominate food delivery. They'd dominate any other businesses that are related to this. So I believe the Uber IPO is going to be a big deal, and it's set to come as a company that's going to be valued at $100 billion. And this is another thing that's really different about IPOs today versus 1999, was the size of them. $100 billion would make it, I believe, the second largest IPO in terms of valuation after Facebook, which came at about $106 billion. And I believe Google came in at something like $80 billion or something like that. So the size of these companies is just really, really enormous. And also last week, I mentioned what I call the Amazon of Africa, Jumia Technologies. Well, that came public and the stock shot up 76%. Boom, just like that. And PagerDuty, which is a less known company, however, this is a big data, artificial intelligence company, also came public, up 60% last week. And PagerDuty is the kind of company that really goes under the radar that most people don't think about. However, this is a company that is collecting data and is something that, for example, we would use. For example, PagerDuty in its IPO prospectus, has these little pieces of information as to how they add value to a business. And they had this nugget, which was very interesting to me, which is that if a website doesn't load up pretty quickly for a business on a smartphone, 53% of people would abandon it within 3 seconds, which really, tells you that, if you're losing customers, it can really be like, as related to something, related to something that you're not thinking about. And it also has had this nugget said that 32% of people ditch a business after one bad experience. And the way they got all this data is by having in excess of 10,000 customers, taking all of that data, compiling it, and creating information out of it. This is the essence of disruption. And there's going to be more companies like this that are going to be valuable. And watch out, we may have an exciting announcement about IPOs in 4 to 6 weeks, or maybe 8 weeks or so. So watch out for that. Popular companies in the news, Netflix is going to be announcing its earnings this week, and that's always a big deal. Apple is being downgraded by a ton of Wall Street firms, telling you what we've been telling you, which is that their base business is in decline. And whatever they want to tell you about services, they're going to struggle to actually make a great business out of it if their base business is not doing well. Tesla, the Model 3 is now the world's best electric vehicle. This is about 2 years in, and they have sold more electric vehicles than anyone else that's been in this business. So this is a really good sign. And in my reading this week, I came across this stuff. I've been talking, if you looked at my Bull Profits Daily from Tuesday last week, I mentioned 3D printing and recommended an unbelievable ETF that will get you into this opportunity. And I thought that this story was just really great. Unfortunately, I didn't have it in time for when I made that video. However, Honeywell, which is a large company involved in aerospace, industrial automation of various sorts, they have a football-sized complex filled with 3D printers. Just imagine a gigantic room just filled with 3D printers. Seems sort of otherworldly. And this is related to their aerospace business, and it produces aerospace parts. And the reason why Honeywell has this is that they're hoping to have as many as 250 parts going into planes and avionics and all kinds of the aerospace businesses that are going to be made by 3D printers. And even though upfront it costs Honeywell, what they found is because of the speed at which they can make the parts, correct the parts, it actually increases their cash flow. And that's because they found that they would lose a customer if they had to wait 90 days to make the part or to correct the part, to go through traditional process. And as a result of this, Honeywell's cash flow margins are actually rising. They're the best they've been in years and years. So in other words, there's a real business case for disruption, real business case for all of the mega trends we tell you about, the Internet of Things, blockchain, artificial intelligence, all of it. Last thing I want to talk about, crypto. Bitcoin had a little dip, went down below $5,000 just for a few days, and now is back up. And I believe that we're in the beginnings of what I think is going to be a massive bull market for crypto and Bitcoin and others. And I saw something today that really tells me why. I saw a news story that said that 94% of endowments, so endowments are these large funds that universities like Harvard and others have, and they invest money for not-for-profit organizations and organizations like that. 94% of them are allocated to crypto. So we're talking about hundreds of billions of dollars that is slowly putting money into crypto as an asset class. And that is why the crypto market, I believe, has bottomed, because there are big buyers that are willing to buy. So I do want to remind you, if you like what you're listening, please like this video, share it, subscribe, tell your friends, and come back again to watch it. Back to you, Amber.
Thank you, Paul, and thank you, Ian. Fascinating information as always. And thank you to our listeners, watchers for tuning in this week. We hope you have a wonderful week, and we'll see you again next week. Until then, take care.